Well, hello again, and welcome to another episode of the Jason and Peely Project. Super excited for Multifamily Foundation today. We've got a great guest, Jason Piro. Hey, Jason, how you doing?
I'm great. Thanks for having me on. I'm really happy to be here today.
Well, I should have asked it. Piro, did I say that correctly?
Pero, but I
Paro.
respond to anything. Yeah.
Paro. Okay, well, good. I
Yeah.
got it from here. And you started your real estate career back in 2001. Him and his
Yeah.
wife purchased the first duplex, bit of a portfolio of rental properties while working as a medical sales representative. So you're out there, you're taking action, you're really growing your business while having a full-time job, which is really something that so many people are really pushed against to get away from their job. And then in 2012, almost 11 years later, you decided to leave your job, but it wasn't until you had 300 units and
Yeah.
that balancing the sales environment, a young family, growing a real estate portfolio. I'm excited to have you today, excited to talk about that. And right now today, there's a lot of fear in the market. There's a lot of people that are sitting on the sideline because they don't know if they should get started, if the world's going to blow up, or if it just comes back. Your properties, right? Talk about the landscape of your properties. You built them over 11 years, and you've built, and I'm sure it's grown even now as you continue to grow and continue to do this work. 2001 was not the safest time either, right? So there's not really the deemed safe time to get started, but we find the people who jump in with a plan in mind really are the ones who are ahead as we have this big rise in place. So
Yeah.
when you first got started, what was the draw to that duplex?
Well, yeah, our first, when we were starting out, I mean, the goal was simple. I just wanted to, I was a few years out of college and wanted to become a millionaire. I mean, it was the simplest goal at that time, but
Yeah.
I didn't know what that was. I didn't have money. My family didn't have that kind of money. And I thought, well, this would be a great goal. And so, long story short, just saw that the path that most millionaires or multi-millionaires had was they also owned they all owned some real estate. So, went down that path, bought the first duplex, closed on it like a week or two before 9/11. And of course, we didn't know, no, it wasn't 9/11 that was the problem for us here in Erie, PA. It was, all the economic aftermath and that uncertainty and, the wars and things like that followed that caused some upheaval, but we kept, my wife and I both had day jobs. We saved our money, followed, the discipline of just doing it the old fashioned way, saving up for down payments, putting that down, buying a property, and getting traditional bank financing. And, we did that for several years and grew that portfolio, like you said, up to 300 units in 2012 when I ultimately left my day job. We've since grown that. We're up to about 900 units right now, 600 of which my wife and I just own together, and 300 that we've syndicated. We have 127 units that we are closing on in about a month. Right now, we're mid-April. It'll be, the closing date's targeted for May 18th. And that'll put us over 1,000 units all told. So we self-manage. So what we own together and then what we've syndicated, I'm the, sponsor of the deal, the quarterback of the situation. So, so that's, over 1,000 units under our ownership here.
Let's talk about that. The breakout of the size of your portfolio.
Yeah.
We're going from 2 to what's the largest property?
About 200 units.
About 200 units.
Yeah.
So doing that, have you always self-managed?
Yeah. I didn't know any different. I mean, 20 years ago, I knew there was property management companies. But I thought, well, why would I give up this money to somebody else that, we were already, early on, we did everything ourselves, from leasing the units to mowing the lawns and things like that. And I'm not handy at all. My wife will tell you I'm probably the worst painter out there. But as we grew, we were able to take on deals that came with a maintenance guy or came with a property manager, and we were able to build a company. I just didn't know any different. And that's, again, of course, if we invest out of our market, we would have to have, of course, a third party management company or build one. But I really like that control of managing our own properties.
Is everything local? Is everything within range of you? What's the farthest property?
15 miles.
15 miles. Yeah, that's super, right?
Yeah, so in our same county. Yeah.
Yeah. So we've talked about that at a certain point, but all of our properties are 1,000 miles away. So it doesn't give us that angle, but starting there, you said it the best way. We didn't know any other way. Right. And so you get out and you figure it out. And sometimes not being handy is the best thing, right? Because then you can't get stuck doing it. And I think that was one of the main we focus because we have heavy construction family background here. So we find that the closer things are, the more we get our hands in it. And then that just limits everything. Right.
Well,
And so
right.
if you can use the powers go. So would have been some of the points here for people? Because right now is a time like people are going to have to look at, you're either finding a way to increase income or lower expenses. Right. And so people are going to have to look at their properties hardlined. And some of them, if they didn't allocate correctly or maybe taking back property management, it just might be something they have to do. Give us some talk track or some guidelines or some lessons learned on the property management side as the operator.
Sure. Well, just to touch on, something you said, right now there's a lot of uncertainty in the market. Something that really struck me as interesting, a month ago, and as everything's shutting down, in early and mid-March, all of a sudden there's all these syndicators talking about deferred payments with their lenders, forbearance, all this stuff. And that's a little bit premature. And in my mind, if you're going to do big boy and big girl deals, you need to have your big boy and big girl pants on. Like, I'm like, don't you have 6 or 8 months of reserves already? I mean, if you're running that razor thin, but again, I know we were in a market where deals are so competitive. A lot of deals are razor thin that maybe that might pose some challenges for a lot of folks. But for us, now the stuff we own together, I don't keep reserves like that. I mean, it's a different animal, but our syndications where we have passive investors entrusting their hard-earned money with us, we've got reserves 4 times like this. And truth be told, our collections are where they always are at this point. And I think, April would be the most challenging month because, in our market, at least, unemployment compensation, federal stimulus money allows people to pay for the basics. And if you run your own property management company and you treat people fairly and with kindness and compassion, and, your tenants are generally going to pay the rent. I mean, on a size of scale, you're always going to have 1 or 2 jokers that are going to try and game the system. But, so now the coronavirus is the excuse. What's the excuse? 3 months ago or 3 months from now, there's always going to be somebody trying to game the system. But I think if you treat people well and work with them together, we'll come out of this on the other side. Now, I'm just speaking to my market. I mean, San Francisco, San Diego, totally different story. And I really feel bad for the owners that are suffering. But I think that, at the end of the day, I said, look, if I have to go out and mow lawns again, at least my own apartments, that is what I will do before I ask my bank for a deferred payment.
I kept thinking this analogy, right? And the analogy was, so my toe hurts, so I cut my foot off just to find I have a hangnail, right? And it was like, there was such a harsh reaction, like fire employees on this point. Like if you're going to jump off and then you bring those employees back, if they find that every time that something gets tough, right, you're going to cut them loose. I mean, what's their commitment to be with you, right? And you have to look at your properties. We had no feedback. We had people getting told to be home, and that was it. And so people were going off the deep end. There was a lot of that. And the same thing. We've had very strong collections for April. I think the thing that will come up is that if the stimulus money doesn't trickle out as quick as possible, and maybe unemployment may be but a little more challenging because people, especially if people get their stimulus check and they're not having a finite time when they go back to work, sure, maybe a little more challenging at that point. But the forbearance thing, you have to look at the reaction to that, right? So if you do that, is that going to help, right? Because is that really going to help you? Because that money, you're not like, that's not money that's washed away.
It's not free.
It's not free. It's not like, we'll just put it in the end and wash away. That now goes over 12 months. And there's a lot of restrictions to that right there. If you go in there, it's almost like a death sentence. So you have to be very careful. Yeah. If you really are pushing that angle, and I knew 8 or 9 people that did it, and the thought track to it, I don't know if there was. It was just, okay, it's here, we'll take it.
They just overreacted. And I think you have to lead with a steady hand. I mean, if I'm wrong, I'm wrong, but and it's, again, just my opinion, but I think, real estate, rental real estate, the multifamily game, whether it's single family homes or 1,000-unit complexes, it's one of the most recession resistant investments there can be. And especially in a market like ours in Western Pennsylvania, and even secondary markets, this isn't, it's not San Francisco where your average rent is $5,000 a month or whatever it is right now. I mean, just normal working class types of apartments. I mean, you have to lead with a steady hand, not only for your company, and you can't overreact and fire people and go crazy. And you can't, but lenders have a long memory. And one of my friends in the business said to me, he said it best. He said, what you're basically signaling to your lender is that you're insolvent. Like April hasn't even hit, and you're asking for forgiveness on something that, so if it, maybe it's happened or maybe it hasn't happened, but what is that signal that you're sending to the lender that either you're not as strong of an operator as you've claimed, you're insolvent. I mean, when you fill out these questionnaires, especially with agency debt, we have it with our local banks too. Have you ever been, behind on payments? Have you ever declared bankruptcy? All these things that, I don't know that it entirely, like if you're really in, like suffering and your deals are about to go belly up, I guess by all means you do what you can to try and, save it. But I think for the vast majority of us, that's just a bad decision.
Yeah, this is like small business overall too, right? So some small business, unfortunately, this really put them over edge, but there was other ones that just weren't going to make it anyway, really. So at that point, like this just quickened the process, right? It's the same thing with apartment buildings. If you have to look at a process, and even now, right? If you're going in and the only way your project worked was that you were getting $400 rent bumps, and you're really at that point, that might have been a bad business plan from the start. If that's the only thing to go in there. You got to think on that, right? The world has been good. It's been a long time since we've felt a crunch, right? 12, 13 years, and now it's a crunch. And could it happen just a couple months and people get back? Sure. Could we have a blip in, the end of the year? Sure. But we don't know. We really don't know. And to have the panic mode, right, across the board, your investors won't like that either, right? If you're not keeping your head on straight, at the second of anything. So right now is a time for patience and really just working with it. And you said the great point here is that if you go into there with the start of buying these buildings to make them a better place to live, then your tenants are going to understand that, right? Because you are right. It is a recession proof because we still have a limit on housing compared to how many people need it, right? And so when you think about that, okay, a lot of people get out of job. Maybe we'll have some decrease in our rent projections, right? But in that fact, where are all these people going to go? Like we're saying, like we have 80,000 people under the bridge in every town. Like where are all these people going?
Right.
And you think about that. So you've built out your portfolio, and now how is your due diligence change for this 127 unit coming up? Is this an agency loan? Is this?
Yeah. Actually, I got the text about 5 minutes before we jumped on that they finished. Today was the appraisal and all the party inspections. So it was really interesting. Just a quick side note. I mean, they everybody was geared up in their hazmat suits and protective gear, and they had tenants that were not there, and there were some tenants that they said, hey, if they were there, they would FaceTime with the tenant and let the tenant walk through the unit with them.
Oh, interesting.
I found that really interesting, and then they just walked around and practiced proper social distancing and everything like that. But we entered into contract, did our, at the end of February, did the due diligence period before everything kind of locked down. We tend to be pretty conservative on our rent pushes, so that when we sell this to investors, that everything I know that we'll be able to achieve becomes like a bonus, and they're like, oh wow, this is so great. And then we're under promising and over delivering, rather than trying to make it fit. So there are rent bumps in place, but even initially we said 2.5 years to 3 years to push the rents, which to me seemed like a forever. I'm like, what? This is stupid. Why would we take it out that far? But then a month later, coronavirus, hits, and like, well, man, thank God we said 2 or 3 years, because then we're not under any immediate pressure to push those rents. And, we'll, so it hasn't changed it a ton, because we've generally been, like for instance, this particular property, the average rents were $650, and we're looking to push them to $750, when the competitive units in that particular area were like $890. So we'd still be way below market. Now we'd say, hey, what can we do to get these right up to the market? But we still try to underwrite very conservatively, and this, even during good times. So when we kind of went back and looked at our analysis and said, we don't need to change anything because we were so conservative, and we took a long-term approach. So we're not under that gun to push rents like in 6 months or a year, you know what I mean? So
And how do you, so the additional now reserves that are requiring for escrow, that's now part of it. So that's a different angle to look at. And so how are you treating that? All right.
So for this particular deal, we got our term sheet before.
Oh, interesting.
So they said they would honor what we had. So we weren't really not too fazed by that. Now that'll, our lender has said to us that, it's hard to tell, but expect some things to kind of peel back in over,
next
like
couple,
3-6
next,
months. But all these people that are like asking for forbearance. Well, I mean, what do you think the lender's going to do then?
yeah,
Like,
exactly.
okay,
Yeah.
well, okay, if everybody wants forbearance, we're going to ask you to have 18 months of reserves. I mean, what do they expect? I mean, they're,
Yeah.
I just think yeah, so that'll change on some future deals. But fortunately, in this case, we didn't have to alter that for our
Yeah. And I agree, right? So the reactions to go off the cliff, the lenders are like, okay, we're going to make this as clear as possible to make this as safe as possible for them and for their investors, right? But it will peel back unless the whole, you got 50% of people go to forbearance. They're gonna be like, well, maybe we need 24 months reserves, and this, but it will peel back, then they'll step back off the cliff. They'll say, okay, maybe we'll get back to 6 months, or we'll get 3 months or something at that point. Cause that's a whole nother change to the game right there,
Sure. And to your point, I mean, like when you're looking at, and maybe it is the right thing for these value add deals. I mean, a lot of people are really pushing the value add and pushing appreciation over the last several years. And that never felt too risky to most people, but I'd hate to be in the middle of a heavy value add project at this very moment, where maybe you're in the middle of interest only or a bridge loan. And then the lender's like, geez, man, it's going to take them 2 or 3 years to push the rents as opposed to the year that they told us. And so maybe it is a good thing, especially if you're trying to push rents and still trying to, do these value add plays and improve properties and things like that. But, I think it always pays to be conservative when you're underwriting and plan for the worst and expect the best.
And I agree. And the one thing to take into account if you're going into properties right now, they'll want to really just kick everybody out and really get that rent bump and change the landscape of the property. Well, the tenant base might be a great tenant base. They would just offer less rent, right? So if you can get a $50 rent bump instead of a $100 rent bump and not have to turn the unit and put that CapEx money out, that might be a great option right now. You'll limit yourself in the downside of putting all that capital out just for, $50 more. Now, and you also, how was your approach back when we started having 2008, 2009, 2010 compared to your thought process now? I mean, you guys are still active, you're still going out there, we're still active looking for the right opportunities, but what is your mindset change in the last 12 years?
Yeah. I mean, a lot of the things, the fundamentals of my mindset are the same, just continuing to try and develop myself, make sure that I'm like cool, calm, collected, and kind of coming from a place of I don't want to say of Zen, but trying to be very, very balanced. So that approach hasn't changed because I think you have to control what you can control. So it's about managing yourself and I love watching your guys' fitness videos online. That's like 10 times more important than sitting around and analyzing deals, is making sure that your mind and body are fit. So that hasn't changed. And I think that's like times like this is where it's even more important to take care of yourself, so that, because it's not just about like having strong relationships with lenders or wholesalers or brokers or whatever it is. I mean, that's a given in good times and bad. You have to have strong relationships, but you have to take care of yourself. But when the world started going, when everything was melting down and, the housing crisis and all the aftermath of that in 2007 and 8, at the time we both had day jobs. So we both had really strong incomes. So we're still in this building mode of our business. So I think if somebody right now has that goal of, hey, I'm going to leave my day job. I mean, I still had that goal and it didn't change. I was ready to walk away back then. But, when you're dealing with lenders, especially on smaller properties, agency deals are a little bit differently looked at, a little different. But if you're talking to your local or regional bank, I mean, their concern, 12 years ago was like, well, Jason, you're going to walk away from this job where you're making all this money to run your rental business. And again, what's changed, is I'm a lot more confident now than I was 12 years ago. I would, say, well, yeah, because I believe in myself and believe in my business. But at the time, I think if somebody has a job right now, don't just rush to leave the job. I mean, make sure that you have safeguards in place. I mean, this will make sure that in times like this, hey, do I have 6 or 12 months of reserves for my personal life? Do I have my business set up in a way that will pay me and sustain me and my family, even with a pullback or even with, some disruption? And those are good lessons, irrespective of whether there's a worldwide crisis going on. But when that happened, there was a ton of opportunity that came out after 08. We started taking advantage of all these REOs. So there was all these single family 2, 3, 4 unit foreclosures. So we're buying stuff for dirt cheap, putting money into it, fixing them up, and then just doing the Burr method before it had a name. So I think there'll be a ton of opportunity. And so I think that still working on ourselves, working on our business, again, trying to be steady and stable through these times, because when a lender looks at you and says, you know what, hey, Jason was stable and steady throughout the coronavirus crisis. He was steady and stable throughout 2008. They tend to want to work with you more because they're not worried about you going belly up. And it's just going to make the good times that much better. So I really think that's, it's times like this where it's, if you have this scarcity mindset, that's the time to really try and work on an abundance mindset, work on not being afraid, but rather trying to be open to the opportunities that are going to be out there.
Yeah. And you're absolutely right. The entire part about, mental fortitude and just really improving health, well, that builds clarity for everything else that goes out there. And if you're going to sit there and say, I can't, well, that's going to really push forward to your investments as well. Yeah. And then you're going to look for, okay, what's the weakest place that I can get myself out of, and saying, well, okay, why can't I? Right. And then just finding, okay, well, how am I going to do that? Just changing that wording in your mind. I mean, that powers through, I run a ton, not every day I want to run, but I just do, and that's just it's just, okay, I said I'm going to do it, so I'm just going to do it. And that powers through. And, some days are more fun than others, but that's just part of it. Right. And it's the same thing with buying apartment buildings. You got 100, 200, 300 people living in an apartment building. No, it's not going to go perfect. And if you ever thought it was, I'm sorry, here's the lesson to you today. It's not going to go perfect. Right. But if you control as much as you control, and you have that point, then when these things sidelined, you have the right team around you, you'll crush it. So
absolutely.
Jason's been a huge lesson today. I mean, super great. Where do you go from here? What's the next, if you think like this, next 2-3 years look like from the landscape of your property operations?
Sure. And what I've been doing the last few years, and I'm going to continue with, is just as we add to our portfolio, trimming off some of the bottom, some of the smaller properties. So what I've done is what a lot of other guys have done for myself and my wife is, being a mentor to others. Mm-hmm. So, some of these guys have bought property from me, and I'm owner financing that. That was a great start for me when I had guys that were, 20 years or 15 years ahead of me in the business. And so that's a ton of fun, because seeing some of these guys that are starting out really come into their own and starting to build their businesses. So I enjoy that. But at the same time, we are, expanding our syndication business. We're still buying things strategically ourselves that we enjoy. So I'm just going to continue to work on that and see where it goes. I mean, we have a couple other markets that we're going to explore after Erie, because we sort of getting to the point where we start running out of property to buy here. So we either have to do a ground up construction or pick that next market that we're going to jump into. But
that's awesome.
We've been lucky enough to do it all in our backyard right now. So.
That's incredible. Well, Jason, for others that want to find out more about you, connect with you, where's the best place to find you?
Yep. Anybody can connect with me on Facebook or through my website, perrorealestate.com. Always happy to jump on, just like a free 15-20 minute strategy call. They can go on calendly.com/Jason Perro, and just, we can hop on and talk real estate. I try to make myself accessible, and whether it's somebody just brand new and they want some advice, or somebody that's been in it for 20, 30 years and wants to just talk shop, always happy to connect with people.
Well, Jason, this has been awesome. Just learning about how you grew your portfolio, just really the steps you've taken to really just continue to be consistent throughout, how you guys have scaled up from the smaller properties into the bigger properties, and really just expand it. And even a talk track now about helping others, and this really what that means to you. Super show. Thanks so much for coming on.
Awesome. I appreciate it. I'm glad to be here.
Awesome. And so Jason with the Jason and Peely Project, thanks so much for checking us out. Multifamily Foundation. Today we had Jason Perro on the show, just really crushing it. And if you like what you hear, go down there, hit that subscribe button, give us a ratings and review. I'm sure Jason, just the other Jason, will get a 5-star. If I'm not ready for that 5-star, that's cool too. Tell us what you want. Tell us what we can do better. We want to hear from you. Thanks so much again. Talk to you shortly.